makers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Kriti Gupta in London in for Francine Lacqua. Here's what's coming up on today's program. Now, the euro falling as Germany and France end the third quarter in contraction, all thanks to weak demand. Euro area's numbers breaking. In just a moment, we'll bring that to you live. Over in Japan, the BOJ keeping policy unchanged. No clear signs of a shift just yet, weakening the yen. Plus, over in the corporate space, Microsoft's Activision deal set to clear its final hurdle in the UK after Britain's antitrust watchdog says a revised offer appears to address its concerns. Let's get a quick check at European markets at the moment because, again, you are seeing a lot of digestion. Not a ton of real market reaction, though, but I mean, this is crucial. This is pretty normal. We are expecting what we were seeing in the U.S. to be a Fed hangover. Now, right now, you're seeing the Euro Stoxx 50 down about 0.5%. The FTSE 100, actually the outperformer. Again, a turnaround of this dynamic you've seen between the UK and the continent in the last couple of days, which brings me to the economic data that we are seeing cross the wire already. Euro area September services PMI rising to 48.4. The forecast was 47.6%. So again, 47.6, excuse me. The manufacturing PMI is 43.4. The forecast there at 44. So services PMI coming in a little bit stronger. The manufacturing side, not so much. Joining us now for a little bit more insight on what that means is Bloomberg's Jana Randau. She joins us from Zurich. Jana, your original take on these numbers?
Yes, good morning. Well, a mixed bag, I would say, but overall, probably on the very negative side. We saw Germany and France leading the downturn. The rest of the region pretty much stable, but pretty much stable is really not good news. And especially Germany and France doing quite poorly there. Overall, the data suggests that the entire Eurozone shrank by 0.4% in the third quarter. And now that is obviously a very big number. And what that tells us is that manufacturing, which has struggled for a while already, continues to do so. Orders are shrinking or declining amid weakness, not just in the region, but also on global markets. The stock or the backlog of orders is shrinking. Delivery times are speeding up, and that just tells you, a little bit about the desperate state of things in manufacturing. One other thing in services that I thought was really, really interesting, that input inflation actually picked up again, and that is important for the European Central Bank, of course, because they are concerned about inflation, about wages in particular, and services. The wages play a much bigger role than in manufacturing, and if you see input prices going up, that tells you wages are going up. That tells you that the risk of a wage price spiral is there. It needs to be monitored, and that tells you also a little something about what policymakers have the challenges they face as they go ahead.
Jana Randau in Frankfurt, we thank you as always. We are getting some breaking headlines crossing the wire as well. Lots of breaking news in just the last 10 minutes. Zegona now in talks with Vodafone on the purchase of their Spanish business. You're already seeing Vodafone shares move about 1.3% higher in anticipation of that. So again, some M&A starting to show up in the European space as well. Interesting, as potentially on the macro front, we're talking about essentially the idea of when recession will hit and how monetary policy can actively address that. On the corporate side, though, not seeing that same amount of caution, which is interesting, again, to bring about that M&A space. Again, Zegona in talks with Vodafone on the purchase of Spanish businesses, those shares higher by 1.4%. So we go back to the macro story because, again, in odds with the corporate story, we turn our attention now to this week's big central bank rate decisions. Bloomberg's Valerie Teitel has had a full plate this week. She joins me right now on set. We'll start with the BOJ here. The game changer, the pricing going into Friday, totally not what we expected.
Well, look, I think the market was hoping to see some sort of confirmation that he'd repeat that lines that he said to the newspaper 2 weeks ago about having the possibility of a sustainable increase in inflation by December and then look at possibly ending negative yields. He actually didn't confirm that today in his press conference, saying that their inflation goal is not yet in sight. And when that goal does come in sight, they will think about yield curve control. So he didn't mention anything about inflation recession becoming sustainable by year end, nor did he mention anything about the possibility of raising those front interest rates like he very much foreshadowed in that piece. The press conference is very much seen as dovish. We've seen the yen weaken 0.5% versus the U.S. dollar since he took the stand.
And then let's go from the BOJ to the Fed, because, again, two very different stories. But I would argue the rest of the world, Andrew Bailey included, now taking a page out of the Fed playbook. The BOJ, not so much. Talk to us about the Fed story and specifically the reaction into treasuries.
Yeah, the reaction, I guess, since the Fed, especially in yesterday's move, was to see these higher end yields move higher, that especially when it comes to the 30-year, when it comes to that 10-year yield, had some sizable steepening in the market yesterday. A lot of that coming back down to the fact that the Powell and the Fed have reiterated this higher for longer mantra, and we're now starting to see what that could really mean for the Treasury market. If we don't have a recession or a growth turnaround in sight, these yields will stay high until we do see the U.S. consumer turn around.
Truly a fascinating story. And again, so many cross currents in the bond market, plumbing becoming just as important as the policy itself. Bloomberg's Valerie Teitel, thank you as always for joining us. Let's take a little bit more about this week's central bank action. We bring in Anna Stupnytska, global macroeconomist over at Fidelity International. Anna, a pleasure to be reunited, by the way, on this side of the Atlantic. Let's start talking about what Valerie just ended with, this idea of this Treasury market. How much of the market plumbing, of the digestion story, should these central banks be worried about?
Yes, good morning. I think this narrative of higher for longer has been there in the markets for a while. As we know, the central banks have been telling us that the rate will be higher for longer. But the markets had not been buying it, and market pricing had cuts across major central banks starting earlier this year. What's happening now, I think, is that Powell was very strong in his messaging earlier this week, and the market are finally starting to digest this and to price that higher for longer story. And at the same time, if we look across risk assets, they had been pricing a soft landing, but now the mix of higher for longer and soft landing is harder to reconcile, and that's why we think we are seeing that risk off in the markets since the FOMC meeting.
What is for you the game changer here in monetary policy this week? Was it the BOE for you? I mean, I feel like that's been everyone's answer. Or was it the BOJ, that perhaps UETA guiding the markets a little bit differently to the way they were positioned going into the back half of this week?
Well, I think that the game changer in terms of the message and the impact of the market, I think, was the Fed and the strength of the message. But also, altogether, if we think about the ECB last week, the Fed, the BOE, they are all trying to send, in their own way, they're all trying to send that message that rates are going to be higher for longer. And again, that's something that markets still have to digest and price in. I think the BOJ was relatively uneventful, and yes, it was a bit of a surprise in a way. If we think about the comments that UETA made previously, but it wasn't a surprise for us overall, because we think it will take much longer for the BOJ to be comfortable with that underlying inflation to actually make a change to policy. We think that's probably the 2024 story.
It's kind of interesting, again, when we talk about this idea of what the game changer actually is, because, Anna, I love to say that Chairman Powell was really considered central banker to the rest of the world. To what extent is Andrew Bailey now setting the global agenda, setting a lot of that policy for the rest of the world in terms of experimenting how to deal with this issues you've seen from the demand side and the supply side? Talk to us a little bit about England being the case study for economists to study for decades to come.
Yeah, I think it's interesting, and obviously the UK economy is a bit more inflationary in a way, and we've had a number of structural and cyclical forces driving that inflation, and so the BOE seems to be facing a much sharper trade-off between growth and inflation, and particularly wage growth looks stickier than potentially elsewhere, and that is feeding into core inflation. Now, the BOE has been more open about that idea that a recession might be required to bring inflation down, even though it's no longer explicitly in their forecast. But I think they need to, in a sense, gain a bit more credibility from here. And I think there will be trying to bring inflation and inflation expectation down significantly, even if this means at the expense of growth, even if this means the economy goes into recession. And I think it is a template. That recession in the UK will come earlier, we think, than that in the US. And it is a template for the rest of the world that actually you cannot achieve that soft landing, even though the US is a slightly different story with COVID-related excesses, etc. But it's probably unlikely that even the US will be able to achieve that soft landing and bring inflation down. And you need to get demand lower, and you need to see that recession to get inflation back to target.
It's really, I say fascinating, because on my central bank palooza bingo card this week, I did not have Andrew Bailey becoming kind of, again, the game changer, especially at a time when you look at the BOJ as kind of this experiment guinea pig in monetary policy. Arguably, even the Federal Reserve, England is usually never in the equation. Anna Stupnytska, global macroeconomist over at Fidelity International, giving us some crucial analysis on that story. We go from the macro to perhaps the micro, although there is a macro take to it. Microsoft's Activision deal finally getting UK CMA approval. This coming after they've seen encouragement, or been very encouraged by the positive developments in that process. Now, of course, we know this has been kind of the holdup for the $69 billion deal. You're seeing both Microsoft shares and Activision Blizzard shares higher in the pre-market. I think what's crucial here, though, is that what does the proposal actually entail? We know the CMA has been very vocal about not doing a licensing deal. We are still waiting on those details. Lucky for us, we'll have Sarah Cardell, the CEO of the CMA, joining Bloomberg Television later in the day. Coming up on the program, inflation is slowing, but Governor Bailey says his job is not done yet. What's ahead for the British economy? We're going to dive into that next. This is Bloomberg.
Well, it's a point when we've stopped tightening, because we've had very good news this week on the inflation front, very welcome news. We could see that inflation was coming down, but this week's news is good, because it's a sign that we've had more than we expected, and that's very good. But of course, the job's not done yet. We can't be complacent about this. Our job is to get inflation back down to the 2% target and to sustain it there. So the job isn't done yet.
I hope it is. But obviously I have to leave it to the experts in the Bank of England to make the final decision. But I think both in the UK and the US, what you can see is that if you take corrective action and if you stay the course, you can get inflation down. And in both our countries, it's definitely peaked.
Bank of England Governor Andrew Bailey and UK Chancellor Jeremy Hunt there speaking as the BOE keeps rates unchanged for the first time in nearly 2 years. I feel like I'm okay by saying this really is a historic moment when you look at the BOE, because a lot of people were expecting the BOG to be the game changer this week. Andrew Bailey surprising us quite a bit by saying, look, we are not going to be the different or the differentiator for global markets. In fact, we might indeed be with the trend. At least that's my take. Let's get a more professional take and bring in Anna Stupnytska, global macro strategist over at Fidelity International, and Anna Andrade from our Bloomberg Economics team. Anna Stupnytska, we'll start with you here. I want to talk to you a little bit about what the difference makes in about 6 weeks' time, because at the end of the day, the BOE still has another decision coming up, I believe November 2nd. Why pause now when 6 weeks may or may not make that much of a difference?
Yeah, I think they really were quite opportunistic here. They took that inflation release as the opportunity for them to pause. And they wanted to pause for a long time. They had been preparing markets for a few meetings now, but data was against them. And I think they took the opportunity to pause and reassess. Of course, they will see more data before the next meeting, and they might well hike depending on what they see. But I think this was just the opportunity to pause and assess a little bit, given the data has been in their favor.
Anna, Andrade.
Yes, good morning.
Do you agree with that?
Yeah, I mean, I might be a bit more strong. I don't think they're going to hike again. I think that was the message from yesterday. I do agree that they took this CPI data point as kind of a way out, because honestly, if you look at it, it was just one data point and there was some volatility in inflation. I don't think we had seen a sustained, there was progress made, but we hadn't seen a sustained decline, in underlying inflation for the BOE to pause. So it felt a bit too soon. They took the way out now, but I also think that with yesterday's meeting, they kind of signaled that they're done. Their concerns have now flipped and completely shifted from, risks of inflation persistence to growth concerns. And I think if you look at the minutes, they also kind of suggest that they will be more tolerant a bit to, probably upside surprises in the data, because they say that it will be volatile, and they say that services and wage might not be, the best indicators to be looking at right now. So I think they're done.
When you take a look, I'm going to kind of macro it out a little bit here. When you take a look at, even the PMI data that we just got 18 minutes ago, you're seeing this divergence between services and manufacturing, and that's very normal. We've seen that in the U.S. as well. To what extent does the BOE have a problem of this kind of diversified approach, where perhaps their monetary policy, given that it is such a blunt tool, tackles one part of the economy but not the other? What part is it not tackling?
Well, I mean, I think so far, what we've seen in the data is that residential investment is down. So that's kind of, reacting maybe to, the fall in house prices. And that's all been driven by higher interest rates. I think there's also a point to be made that, consumption might be a bit weaker, but it's true that there we kind of seen a bit more mixed signals. The latest July print was a bad one, but it was, led a lot by strikes. And when you look at, consumer-facing activities, they actually did, pretty well, given the decline. So I think, we have a bit more of a mixed indicators on the consumption front, and I think, we'll need to wait to see more data to see, how that really looks.
Anna Stupnytska, talk to us a little bit about what she just talked about. This idea that, and I mean, we're showing it more so beautifully on the terminal chart here, that this sticky inflation may not be so sticky. And I think, Anna, I'll come back, Andrade, I'll come back to you. So many Annas, so much analysis, so many Annas, easy to get confused. Anna Stupnytska, let's talk about that stickiness here, because again, I'm putting my American hat on. How can Andrew Bailey hit wages harder?
Yeah, I think it's interesting. Central bankers have claimed now that they are doing their job, and the monetary policy is transmitting to the economy, and that's why inflation has been declining. I mean, it's been declining on the headline because of food and commodity prices, and because the base effects have been more favorable. Yes, we have seen some progress in good inflation, and again, this has been driven partly by base effects related to COVID. But I think the progress on services inflation has been very modest, and that's actually the part of inflation that the central banks need to be targeting and should really be hitting. And I don't think that they have been very effective yet. So they claim that they have achieved disinflation, is going in the right direction, but I don't think it's been mostly due to monetary policy just yet. That's why they will have to keep rates higher for longer. And this goes to the whole idea of the transmission mechanism and long and variable lags and how long lags are. And we actually think that that transmission mechanism is delayed. It's not broken. It is delayed. Partly has to do with the debt structure, the structure of the debt markets, whether it's mortgages or corporate debt in the US and the UK. It's just delayed. So it will come later, but the central banks will still have to wait for those high rates to really hit the economy and have an effect on inflation.
We didn't even get a chance to talk about this quantitative tightening story as well. Plenty more fodder. I could really, I think, spend all day talking about the BOE. For now, Anna Stupnytska, global macro strategist at Fidelity International. We will leave it there. And Anna Andrade as well from our Bloomberg Economics team. Thank you both very much for joining the program. Plenty more to come. You don't want to miss it. It's all about the analysis. Stick with us. This is Bloomberg. Now, of course, one of the corporate stories we've been watching where the UK really has some edge is regulatory action on some of the biggest tech names, very specifically the $69 billion acquisition from Microsoft of Activision Blizzard. Now, this is an enormous story. It's been dragging on for months, and the UK is really specific about how they want to tackle big tech when, of course, you've seen a lot of scrutiny come from the EU as well. Well, now you've seen that perhaps they're going to get their final hurdle eliminated, and that $69 billion deal will actually go through. What are the details of that agreement, though, at a time when we know that the CMA has a very unique legal process and way of finding those proposals, We'll bring you more on this shortly. Stick with us. This is Bloomberg. Now, the euro falls as private sector activity in the euro area continued to shrink in September. The slump eased in Germany and deepened in France. Now, the BOJ keeps policy unchanged. No clear signs of a shift. The yen weaker on the day. Plus, in the corporate space, Microsoft's Activision deal set to clear its final hurdle in the UK after Britain's antitrust watchdog says a revised offer appears to address its concerns. Good morning and welcome to the Pulse. I'm Kriti Gupta in London, in for Francine Lacqua. Now, one of the major stories we're watching, of course, is monetary policy around the world. But let's talk a little bit about what the markets are actually doing, because there are two words that are going to scare global tech investors more than the real yield. And that's really where I want to go here. I'm showing you a chart of the 10-year real yield breaking 2%. This is really important. This is a historic moment because we haven't really seen it break that level going back to, I want to say, the early 2010s, 2009. What's important to keep in mind here is that this is the rate that a lot of tech investors really watch, because one of the defensive trades that are in the market is not just U.S. tech, but tech around the world. The idea that there is so much cash that these tech giants are really sitting on. What lessens that cushion, if you will? Well, it's when the real yield is this high. And I think that's really where you start to see the sensitivity increase in the tech space. And that's going to be something we watch. The dynamic between the stock market and the bond market suddenly kicking right back into high gear. Also kicking into high gear, by the way, is economic data. And that's where I want to go next, because we are getting numbers out of the UK. Their September services PMI falling to 47.2. The forecast there was 49.4. The manufacturing data, on the other hand, 44.2. The forecast there, 43.2. Now, very quickly, I want to highlight here that we did get European PMIs at the top of the show. And the difference is that where you are seeing weakness in the manufacturing sector in Europe, you're seeing strength in services. In the UK, it seems to be flipped. A little bit better in manufacturing, a little bit worse on services. Really interesting dynamic as, again, we talk about the market reaction at the moment. A little bit muted when it comes to the currency trade. We are seeing 122 on the cable rate. Let's go from the macro to the micro here, because another major story we're following in the UK and around the world is going to be in the regulatory space. Microsoft got a huge boost in its attempt to clear the final global regulatory hurdle for its $69 billion deal for games maker Activision Blizzard. That comes after the UK's antitrust watchdog, the CMA, said that the revised deal appeared to address its concerns. Now, this is so important because, of course, this has been kind of the last hurdle for this massive tech deal, which, by the way, when it was first announced, really moved the markets, but has been this drawn-out saga going into the rest of the world, specifically when it comes to the UK, which it feels like has been trying to make its mark on tech broadly. So Microsoft shares at the moment, with that final clearance, higher on the day, as is Activision Blizzard, 1.7%. The trading at about $93.92, very, very close to the $95 a share offer price from Microsoft. Let's get a little bit more perspective. Bloomberg's Ruth David joins me now on the program. Ruth, I have been fascinated by this story because who thought, again, on my bingo card, I did not have UK CMA holds up one of the largest tech deals in history. That I didn't see it coming, I'll admit. Ruth, talk to me a little bit about what the perhaps parts of the deal the CMA might have finally agreed to. What did the smooth talking in this proposal?
Hi, Kriti. So one of the big things that Microsoft has done is the restructured offer includes them selling gaming rights to French publisher Ubisoft. And that's able to keep competition in cloud gaming, which is a relatively nascent market, but it will keep it open for a foreseeable period of years. And this was one of the big issues that the CMA was focusing on. If you remember, they differed from other global regulators. The European Union cleared it with behavioral remedies in May. The FTC's court challenge was beaten down by Microsoft. So this is pretty much, unless one of the regulators comes in and says, well, actually, the deal contours have changed, let's look at it again. But this seems like the final hurdle. And you're right, the CMA is really front and center globally with this challenge and with the fact that it's held up this really big deal on concerns that some would argue are quite valid for the consumers.
And it's not the only deal that they've held up. We've had a lot of scrutiny on Broadcom VMware. We've had a lot of scrutiny on Amazon and iRobot as well. The pain that you're seeing in the tech space, specifically when it comes to the UK, especially after a lot of these big tech companies just moved less and away from London because of tax reasons, it feels like the CMA, to your point, is really trying to make their mark. But Ruth, to what end? At what point do you start to see the CMA really start to deal with the fiscal pressure or the political pressure from the likes of Jeremy Hunt and Rishi Sunak? They're actually trying to attract that investment to London, not scare it away.
Absolutely. And we've already seen signals from Mr. Hunt, from the Prime Minister, around why we need investment and why the importance of making the UK seem like an open market. I think two things happened, right? Post-Brexit, the CMA's role changed in terms of what they had to then separately approve. And so that's made a difference. And we are also looking at increased scrutiny around what large technology deals especially mean for some of the nascent markets, what they mean for regulation, whether we're talking in AI, whether we're talking in other parts of tech. The CMA would argue that actually they clear the majority of deals. But I think Microsoft also needs to be taken in isolation because this is a company that has far more resources than an average CEO that is looking at doing M&A. So they can spend the time and the money on these deal challenges. And deal advisors would argue that with the CMA's new influence and new power, there is somewhat of a sobering effect on cross-border M&A especially.
Well, this idea that Microsoft, I mean, their lead lawyer had come out and said if this deal isn't approved by the CMA, I think they'd said this in mid-July, they weren't going to go through with it. They've clearly changed their tone on that as they kind of negotiate behind the scenes with the CMA. Let's come back to the Microsoft Activision deal, to your point, because you mentioned they're a gigantic company, but they also do a lot. Part of the big tech getting bigger playbook is these acquisitions. And I'm worried from a market's point of view that if you don't see that growth prospect, if you don't see the fact that Alphabet can then acquire YouTube or that Amazon can acquire iRobot, for example, suddenly big tech does not get bigger, which I guess is kind of the EU and the UK's point here. But again, Ruth, how much damage could that cause when you start to set that precedent?
I think that is the multi-billion-dollar question, right? Both for tech as well as for M&A more broadly. To what extent is this having, I mean, just the uncertainty factor around transactions, which is one of the biggest risks for company boards and CEOs when they come in and look at these really transformative deals. And arguably with the CMA now intervening in some of these very high-profile deals, we have seen that uncertainty factor increase considerably. And the question is, what does that mean then for a company that says, you know, I want to expand in this market, but hey, this is going to take so long. If you look at the Microsoft deal itself, you know, it's been more than a year and the market has changed from what it was when they agreed to this transaction. So you can ask the question, is it still as attractive for them as it was when they said they wanted to do it.
Again, a fascinating conversation, because now I'm just curious about whether, to your point, some of these other big tech companies come out and they say, well, look at the hassle, look at the legal costs that Microsoft has had to deal with. Maybe we just don't do this. Maybe it's easier to grow in-house, which, again, takes a lot of time. Bloomberg's Ruth David all over that story. We thank you, as always. Later today, we're going to get the perspective straight from the source. The CEO of the UK's Competition and Markets Authority, Sarah Cardell, will join Bloomberg TV. We will have her. We're going to talk about what the details of this deal actually look like. Very excited for that interview. It's one that you're not going to want to miss. Now, UK Chancellor Jeremy Hunt, in the meantime, says that the West needs to have dialogue with China when it comes to AI. Speaking on Bloomberg's Balance of Power, he defended the UK's decision to invite China to its AI summit in November.
We'll invite them. They won't come to all the discussions, but you need to have a dialogue with countries like China. They're not going to go away. And there may be things that we can work together with China on. But, we have to be very realistic, and we have to have those discussions with our eyes open. What we're trying to see is if we can get a global consensus on how to make sure that artificial intelligence remains a massive force for good in the world, which I truly believe it can be. But then if you're going to do that, where you put the guardrails in to stop it going wrong. And the UK has just become the third $1 trillion tech economy globally. We have more unicorns, these billion-dollar companies than anywhere else in Europe. So we are very keen to bring together all our friends and indeed people whose values we don't share to try and manage this next huge development in humanity's tech journey.
I used to walk by the Silicon Roundabout a lot, but right now you're actually dealing with the titans of Silicon Valley in California. Have you convinced any of them to come to this summit in the United Kingdom?
I think we're going to get most of them coming.
Like Elon
you're
Musk?
Absolutely right. Well, actually, he's someone I haven't spoken to, but he'd be very, very welcome. But I just say this, we are Europe's Silicon Valley now. Since you lived in London, Anne-Marie, there's been a huge tech explosion. And, we are really proud to be able to make a good contribution to this debate. It's much better that we try and grip this right from the outset. And I think, from the point of view of investment going forward, investors want to see that governments have figured all this stuff out. And then when they do, they're going to start to put in really huge sums of the money. At the moment, we're getting a lot of money being spent by the really big players. And we've got quite a few startups. But if we're really going to make this the huge opportunity it can be, then we need to get some kind of consensus about how to keep it safe.
UK Chancellor Jeremy Hunt there speaking to Bloomberg's Anne-Marie Hordern and Joe Matthew. Actually says London's getting more tech investment. We're worried about it getting less, something we'll be diving into the later hours of Bloomberg TV, I'm sure. Coming up on the program, Chevron has reached an agreement to end strikes at a key LNG facility in Australia. We're going to discuss that next. This is Bloomberg. Russia's decision to ban diesel and gasoline exports is adding to the risks of disrupted fuel supplies ahead of winter. Let's bring in Bloomberg Senior Executive Editor for Energy and Commodities, Will Kennedy, a favorite of the show. Let's talk about Russia's strategy here. I mean, we already know that things are really, really tight in the diesel market and the refined products market. Is that why they're doing this now?
They have problems domestically with their own tight diesel market. There are strong demand pulls in Russia right now. The war requires quite a lot of diesel, and at the same time they're pulling in a record wheat harvest across Russia, which is an incredibly diesel-intensive activity. On the supply side, they have some big refinery maintenance going on. So you put that together, and Russia, which typically exports a lot of diesel, is actually quite short, and prices domestically are relatively high. So they do have a domestic problem to solve. That said, if this lasts for any length of time, it does impact an already tight global diesel market. Diesel is absolutely vital for the function of the global economy. As you know, trucks especially all require, the delivery of goods around the world requires huge amounts of diesel. So it will have an impact. The question that a lot of people are asking is how long this can last, because once Russia has solved its domestic shortages, it will rack up big diesel stockpiles very quickly because structurally it has a big long in diesel and needs to export. So it is a big event. The question a lot of analysts are asking is how long can it really last?
When I think shortage, I'm old enough to think LNG. And that's how I'm going to get to my next topic, because I have no real transition between diesel and LNG. Members of your team, your BN reporting team, told me 2 years ago when the war in Ukraine first began that LNG comes from Norway, from Qatar, from the United States to some extent. So when you have all three of those major hubs basically say, we don't have that much to offer the rest of the world, there really is no time or place for disruption. It feels like we can breathe a sigh of relief on that front.
It does. So the threat of a big strike in Australia, which is another key exporter, has receded. Chevron, which had a long-running dispute with its workers at 2 LNG export projects, reached a deal overnight. They accepted the recommendation of the Australian regulator. It means some very generous allowances for a group of workers who are working on those remote LNG facilities. So it probably more money than Chevron wanted to spend, but at a time when the LNG market remains very tight ahead of the winter in the Northern Hemisphere, this will be a relief for many gas traders.
You know, Guy Johnson, I think, had Mike Wirth on his show, and he said, if I work for you, do I get a raise? Because you have these record profits, and he kind of evaded the question. It's interesting that I imagine a lot of folks in Australia are saying the exact same thing. Will Kennedy, Bloomberg Senior Executive Editor for Energy and Commodities, we thank you as always for your insight. Let's stick with that theme, though, because Will was just talking about strikes over in Australia. Well, strikes are truly a global theme. Specifically, it's a story we've been following in Detroit, Michigan, the United States. The big three automakers could potentially explain later today unless substantial headway is made towards new labor contracts. What's interesting is that ahead of that, pre-market, you're seeing Ford actually higher by 0.3%. General Motors, not so much. But that's actually underperforming a market that's already seeing a little bit of green on the screen. But again, this is the kind of warning that the UAW union is giving at the moment. It's calling its first ever walkout across all three of the legacy car makers last Friday. Now they're saying they could expand it. Let's bring in Bloomberg's auto czar, Craig Trudell. Craig, how long is this going to go?
So I think it's essentially a foregone conclusion that we're going to hear from the UAW today, sort of next steps in the strike. As you mentioned, it's across all three companies. As of last week, was just a handful of plants across those three companies. That's left the union with some options, whether it's sort of picking new plants to strike and giving these three that have been shut down a break. Or just adding to the pain. And so I think, the general expectation here, given the fact that the sort of bid ask between, what the union is asking for and what the companies are willing to accept, it's likely that we're in for, weeks, potentially months of striking here.
Well, it's fascinating to me because we all want pay raises, right? That feels normal, like a normal thing to ask. But it's almost tough because on the one hand, you're rooting for them, right? You're saying, look, I get it. I also want a raise. So yeah, you go get that raise. On the other hand, if you do that, the ripple effects could actually hurt people's pockets, like you, like me, like anyone in Detroit, because of those margins that end up being in those car prices. How quickly does that ripple effect actually take place?
I think in terms of, if it's the case that the union wants to sort of, switch up, which strikes which plants it strikes at and sort of gives workers a break. Because remember, when these workers do go on strike, they have to go on $500 a week pay. So it's a pretty substantial hit to their income. Potentially they could sort of mix and match plants, and maybe that leads to sort of less disruption in terms of, prolonged losses of production. And we are seeing, just in these three plants that have struck already, pretty big disparities in the amount of inventory that these companies have of these cars. One to flag that, we could see some changes at the retail level is, say, the Ford Bronco. It's a very, hot commodity. The fact that was already in short supply and now is going down at least a week could mean that, you already weren't getting a great deal on that. you're potentially going to have to pay even more.
And that's just the U.S. automaker space. And here, I keep saying stateside. We're not stateside. Whatever the U.K. equivalent of that is. Here in the U.K., then you have the petrol and diesel part and part of Rishi Sunak's ban. A topic for another time. Bloomberg Auto czar Craig Trudell walking us through the car story around the world. Now, coming up on the program, it's a trio of recent IPOs. They were pretty shiny and bright. Now they've lost a little bit of momentum, only days after their debut, including the biggest of the year, ARM Holdings. What happened? Details next. This is Bloomberg. Welcome back to the Pulse. A trio of recent IPOs have lost momentum only days after their debut. Shares in ARM have fallen for 5 straight sessions. Instacart briefly dipped below its debut price on day 2, with shares having stabilized since, but still failing to regain ground. Klaviyo also well off levels hit during its debut. I mean, there's so much on the surface pain in this market, but look, they just debuted. You got to give them a little breathing room. Bloomberg's Julia Fioretti is going to join us now to tell me if I'm right. Is that fair to say? I mean, IPOs are always so propped up. There's always so much excitement, especially when it comes to tech IPOs. Is it really all that surprising that they've dropped back down?
It might not be entirely surprising, actually, although it's certainly disappointing for many watchers who were hoping this would be the big reopening moment for the IPO market. And so it's a bit of a coming back down to earth. 25% day pop, first day pop is very nice, but obviously that share price gain needs to be maintained over the long run. I think now we're seeing a little bit more sort of the exuberance come out of the market. Obviously, we're only still in the first few days. There were the comments from the Federal Reserve on Wednesday, which obviously saying that interest rates might be raised again one more time this year and would stay higher for longer. That obviously was a drag on the broader market and on these 3 names in particular. So with this more grim backdrop, obviously, it shows that valuations are still an issue for tech companies. The need to generate cash is still key. And obviously, a lot of these valuations were predicated on their ability to grow profits and to grow revenues by a high percentage, and obviously that has now been called into question.
All right, Julia, I'm going to put you on the spot here. 30 seconds. Do we have a read-through between these IPOs and the others that are waiting?
Well, we've already seen, actually, some of the ripple effects. The Vietnam-based internet startup VNG has decided to put its IPO on hold as it waits for better market conditions, we've reported. And so that obviously shows that there is now some caution. So we're not going to see, perhaps it was premature to expect that there would be a huge market reopening just on the back of these 3 IPOs. But certainly now the market environment out there remains tricky. It remains quite volatile, and there's still a lot of macro uncertainty. And so we're not going to be seeing the floodgates open completely. And basically, people, I think, will be sort of more cautious going forward.
Certainly something we're going to be keeping our eye on very, very closely. Bloomberg's Julia Fioretti, we thank you for joining the program. Up next, Bloomberg Brief with Danny Berger in London and Manus Cranny in New York. They'll dive into everything you need to know from the European session going into the New York session. It's a conversation you do not want to miss. Stick with us. This is Bloomberg.